is if I were to start a business today in the D2C space, I would want a minimum of 60% and ideally closer to 70% gross margin. If you're not profitable at the first purchase, you don't acquire customers with first-time customers, you acquire customers with repeat customers. You want to understand your product margins, so you got to separate your product landed costs away from, last mile delivery. That's why I always suggest to look at LTCM, which is a different version of LTV.
Hello and welcome back to the StoreHero podcast. This week we're joined by Valentin Kuznetcov. Valentin, welcome to the show.
Thank you, Thomas. Appreciate you inviting me and happy to be here.
Valentin, tell us a little bit about who you are, what you're working at. I know we just had a quick chat before we jumped on, but just for the sake of our listeners here, it'd be great for them to get a bit of an understanding about you and what you guys are working on.
Sure, yeah. So I run Optimizator Financial, which is a fractional CFO firm, but we're now sort of repositioning to be a growth consultant in the D2C and SaaS space to basically help businesses understand their financial data, their numbers better, and then figure out how they can actually build strategies and action those numbers in a way that results in better financial outcomes. So we've been doing that for the past couple of years, and it's been rather successful.
Absolutely. We've had plenty of chats back and forth. Obviously, there's a lot of crossover in terms of what we're working on here at StoreHero and how you guys are kind of looking to help brands as well. What's the difference between a fractional CFO and a growth consultant?
It's a good question. A fractional CFO primarily focuses on the finance side. They don't really look at the marketing side or at the operational side of the business as much. So they have a top level overview of the finances and they give recommendations based on that. As a growth consultant, we focus on how we can use finance across the business in the marketing space, in the operations space, how we can optimize those aspects of the business and then apply that to finance to figure out how we can unlock resources in the business and use those resources in the most profitable way possible to fuel profitable scale of the business.
Okay, so a lot of fractional CFOs that I'm aware of and would speak to, they would, in most cases, not all, would have responsibility of the bookkeeping element of the business. Yep. Is this a shift in terms of, I suppose, responsibilities and things that you were responsible for now as a growth consultant versus a CFO? Or, as a CFO, were you even responsible for the bookkeeping elements of a D2C business?
Yeah, so that's why I'm kind of changing the positioning is that we don't offer bookkeeping and we don't offer accounting. We work with bookkeepers and accountants to build a better system, but then we come in as a finance growth consultant, essentially, who basically helps with the strategy, with the operations, with the marketing side to tie it back to financial outcomes and build better systems, better results for the business.
How many D2C brands have their bookkeeping in, maybe not the most optimum position? Often we're speaking to brands, and when we actually get to look at the bookkeeping side of the business, it's often being done by a bookkeeper who isn't necessarily overly familiar with the industry, and that can definitely lead to complications for maybe the likes of yourself.
Yeah, that's one of the biggest issues is that a lot of bookkeeping agencies are not familiar with the D2C space specifically, and they come in and apply the typical templatized version of books for that D2C business. And then it doesn't really paint you a holistic picture of the business. And then as a result, a lot of operators and business owners struggle to draw any meaningful insights from that data. And they actually start hating accounting and bookkeeping as much as possible. And they don't really engage with their accountants. So one of the first key steps is to actually understand how we can structure their books in a way that is meaningful and we can derive actionable insights from. And that's one of the things that we as growth consultants come in and help them with.
I'm smiling because I can definitely resonate, and I've spoken to plenty of those people, and by the smile on your face, you have definitely too. Just before we kind of dive into maybe some of the more stuff that you're looking at now at Optimizer, if you were to see some of the maybe top 3 challenges that you've seen with maybe D2C friendly bookkeepers and how they approach books versus and maybe an agency or a bookkeeper that is familiar with the industry, what are some of those kind of, that you mentioned, that kind of boilerplate template that is applied to D2C businesses that maybe doesn't necessarily fit the model? Is there certain challenges or consistencies that you see done wrong when bookkeeping is just boilerplate and applied to a D2C model?
Yeah, for sure. I think one of the key differences and one of the things that is misunderstood is the profit contribution right? And the way it's structured in the traditional P&L is very confusing. What I typically recommend is to split everything as much as possible in the profit contribution section, and specifically being, you want to understand your product margin. So you got to separate your product landed costs away from, last mile delivery fees. And typically those are bundled together, and you don't really know exactly how much you're paying for last mile delivery versus landed product costs. And then you want to understand, after you understand the product margin, you want to understand your gross margin, which is, the profit after all of your supply chain costs, essentially. The product landed cost, the cost of delivery, which is last mile delivery, and cost of transactions, so payment processing fees. That's your gross margin, right? And those concepts are constantly, conflated and used
Yeah.
interchangeably, right? So sometimes you hear businesses say gross margin being the product margin. So they say, 80% gross margin is, is our, that's what our product margin is essentially. But they say gross margin, right? And it's very confusing. You don't understand the full picture. And then the third step that I typically recommend to include in the profit contribution is the direct marketing. So paid ads and anything that is incurred to drive revenue directly. And most of the time it's excluded and it's bundled with OPEX, and especially in QuickBooks, because QuickBooks doesn't allow you to have that other variable section. But in Xero, you actually have the ability to customize the report and allocate and move the direct marketing into your variable cost section to understand your profit contribution margin. So that would be the main sort of issue that I have with a lot of bookkeepers. But another thing that is also you know uh, done poorly is the OPEX section. So there's a lot of unnecessary and confusing buckets that don't actually communicate anything. And sometimes you see cloud tools, for example, being added to the office expenses, and you wonder, okay, is it really an office expense? So I understand in the traditional corporate, you know, space, you would add office expenses or cloud tools as office expenses, but for a
Sure.
D2C business who relies on technology to drive its operations, you want to have a clear bucket of cloud tools and software that is separate from office expenses, because those are slightly different, right, and serve a different purpose. So I would say OPEX buckets being very confusing, and the profit contribution section lacking a lot of detail and materiality.
What challenges does that like for a business who is just lumping their product margin, gross margin, and even contribution margin, because I've seen that, and just lumping that all as gross margin? Why is that a challenge for an e-commerce business, and like why is it beneficial to break those out into three buckets? I completely agree with you, but again, we both see a lot of P&Ls where all of that expense is just lumped in and just categorized as gross margin. Why do you think it's helpful for D2C brands, particularly, to break those up into three very distinct different sections?
Yeah, I would say it goes back to the unit economics analysis, right? So when you have a clear structure on your P&L, that section, the variable section of the P&L, the net revenue, the variable costs, and direct marketing, all up until the profit contribution is really your unit economics. So if you take those numbers and you divide them by the number of units or the number of orders, you get an understanding of your unit economics. So when you build your P&L properly from the get-go and you simply use units and orders, you don't have to know how unit economics is structured. You simply take the P&L divided by those numbers, and that's it. That's your unit economics. So that's one of the biggest reasons why you want to have that level of detail and segregation of data. But more importantly is again, we want to use our accounting and our numbers to drive action. If you don't know your your product margins, your gross margins, your profit contribution margins, what the typical industry benchmarks are, even though I don't recommend looking at industry benchmarks, you have to look at your own business and benchmark it against your own performance historically. But you still want to have that level of understanding where you're potentially falling short and where you should be allocating resources to optimize your business. And one of the biggest things that is confused as well is that you can't optimize gross margin, and that's not true at all, right? There's so much you can do on the gross margin side, and I have a lot of case studies that I can demonstrate, how I came into the business as an operator and fixed gross margin, boosted it by 15%, right? And it's easily done, but you have to firstly understand if you're falling short in the product margin or cost of delivery category, right? That's the first step, because if you don't know what the problem is, you can't fix it.
100%. And I was actually recording a podcast last night about an e-commerce business I actually started 10 years ago. And I was
Mm.
certainly, somebody who just got everything wrong in that I had I just assumed that my product cost only was my gross margin. I wasn't taking into account that I was giving these people free shipping. I wasn't taking into account the 20% discount that I was giving everyone. And I just had it all completely wrong. And definitely mistakes made, but lessons learned that have ultimately led me on the path that we're on today. Valentin, we kind of touched on before we jumped on there. You've just started a new cohort program that you're working with at Optimizer. I'd love to just hear a little bit more about it. I suppose why it came into fruition. What are you guys working on? Maybe break down some of the key pillars that you kind of mentioned before we jumped on. I think they're so interesting, and I think they're definitely there's tons in there that we can unpack that I think will be really really valuable for everybody listening today.
Absolutely. Yeah, so I actually just wrapped up the first cohort yesterday, so it's perfect timing. Yes. And that product came about on its own, to be honest. I built a community and an audience who were very vocal about the issues and things that they wanted to learn about. And it started out last year. Based on the feedback, I knew that I had to build something to basically enlighten the finance side of the e-commerce business. And as time went on, a lot of projects you get overwhelmed, but then you actually sit down and you think, well, I can actually add some value and build something meaningful that could be, a long-term investment in the community and myself as well. And last month I launched the little offer, in the Google Sheet, got a lot of response from it, filled the cohort pretty much immediately, and jumped straight in. So the program itself is centered around four key topics. The first one is the fundamentals of profitable scale, which is the unit economics, the P&L, how to read it, how to, conceptualize the idea of profitable scale, right? And again, there is a lot of confusion about what profitable scale is versus profitable growth, right? Um, you know, Profitable scale is growth from consistent growth of revenue from reinvested profits, right? Whereas growth eliminates the aspect of profits. It's just a pure revenue metric, right? And
Very
that's
different.
very different, right? So scale is profit and cash flow in mind. Growth is just revenue in mind, and you don't really think about it too much, right? So that was the first topic. The second topic is how do you actually use cash flow management to accelerate profitable scale, right? One of the key components of profitable scale is cash flow management, cash conversion cycle, right? You take a dollar, you invest it, then something happens, you get that dollar back, right? And then you reinvest it back in the business and you scale that way. So as long as you're profitable, you can scale. But the cash conversion cycle will dictate the rate of scale, how quickly you grow, right? How quickly you scale. So that's another component and the other topic. The third topic was how do we actually derive actionable insights from data and numbers? So that's what I do as a consultant, right? And I have my own playbook, which consists of 15 questions that I come into the business and I ask those questions and I follow the template, answer those questions, and then I know exactly where the business stands. And I shared that playbook in the cohort program. And the fourth session was all about understanding how we take those insights and we convert them into action and strategy. So I shared some of the case studies, real life examples that I did previously to convert those financial insights into strategy and action. So that was the cohort, and these are the four live workshops or live sessions that I conducted with the group of people. And I also offer a one-on-one personalized session that you can sit down with me and apply the learnings that you pick up on during the cohort to your own business, your own clients, whatever it is, because there's a diverse number of people from different domains of e-commerce space who joined the program, and I was super pumped to see that. But yeah, that's the program in a nutshell.
Amazing. And I know we have one or two shared clients as well, and they've only had extremely positive results and things to say about the work that you've done with them as well. So it's definitely something I can attest to. And obviously, I see all the content that you post all the time, and it's incredibly valuable. And it's definitely, anybody listening to the podcast should definitely give you a follow on LinkedIn because you post top tier content multiple times a week, and it's all extremely relevant to D2C operators globally. Valentin, let's jump into the first one. So, fundamentals of profitable scale. Talk to me about that. I know we could go on for hours, but let's just kind of go top line. Let's just dig into a little bit of the detail, and I'd love to hear a little bit more about it, really.
Yeah, without digging too much into it, I mean, the main idea behind profitable scale is actually being net profitable, right? At the end of the day, any
Sounds
business
basic.
sounds basic, right? But yeah, you gotta be net profitable. What does that mean? So you have your revenue, you subtract your product landed costs, you get your product margin. You look at your product margin, you subtract last mile delivery, transaction fees, you get your gross margin. You take your gross margin, you subtract direct marketing, you get your profit contribution margin. You take profit contribution margin, you subtract OPEX, and you get your net profit margin. That's it, right? So as long as you have net profit margin, and let's say it's anywhere between 5 and 15 to 20%, which is EBITDA, right? Net profit margin is just another way of saying EBITDA, unless you take into account other costs, which is kind of separate, right? So let's say your EBITDA is 5 to 15%. That means that you already have what you need to scale profitably, right? Because all you need to do now is to take that profit, manage the cash conversion cycle, right? Because profit is just the starting point. Then that translates into cash flow. So you got to take that profit and you got to manage that profit well enough so that it translates into cash flow in a meaningful and reasonable amount of time. And you can then build a machine that fuels profitable scale. Yes, exactly. So you kind of like recycle the cash flow in the business, the profits in the business. But again, it all starts with net profit margin. And the formula is extremely simple. You take your total profit contribution dollars and you subtract your OPEX dollars, and that's your net profit dollars or net profit margin, right? As long as your profit contribution dollars are above OPEX, you can start being profitable. When you're profitable, again, you can fuel that profitable scale. And again, if you follow the total profit contribution dollars in more detail, you break it down into specific components and levers that you have as a business to pull and play with, you understand how profitable scale functions. So you see, okay, it's average order value, it's customer acquisition cost, it's gross margin, right? So we take all of these components together, we can go even deeper with each one of them because your average order value is what? It's your retail price, average retail price per product sold. It's your units per transaction or average units per order that customers buy. It's your discount rates. It's your refund allowance. It's your shipping collected, right? So all of those are components of the average order value. So you start looking at all of those levers. You see how your performance builds over time or changes over time. And then you can start benchmarking that performance. And then you know that if that changes or one lever changes, that will translate into more net profit margin because our OPEX dollars remain the same. So it's all
Sure.
about, it's all about the unit economics, the volume that you're driving, and then how efficient you are on the upside. And then you translate that into the net profit margin.
Okay, so that's interesting. So I suppose the real distinction there is that we're not just looking at just direct lines within a P&L, but we're also fusing in e-commerce and marketing metrics that are extremely applicable to an e-commerce business and trying to formulate that back into a plan in order to drive that kind of profitable scale and profitable growth for a business. One challenge that I consistently see with businesses is that, I'm not sure if you'd agree, but maybe conflating the two ideas of, growth and scale to be the exact same thing.
Yeah,
The kind of underlying assumption that as long as we grow revenue, we will grow profit, but that's not always true.
exactly. Exactly. Yeah. And scale is all about profitability and cash flow. All about that, right? And revenue growth, this mindset of growth at all costs versus scaling profitably with cash flow in the bank, right? Is that difference between someone who is basically growth oriented versus an operator, right? Who wants to build something sustainable long term with cash flow in mind.
100%. Definitely. And I just think in an era of we just have, much more increased customer acquisition costs, rising
Yeah.
customer cost of marketing in general, that, those two things are definitely not equal anymore. Maybe in years gone by when, customer acquisition costs were just infinitely more efficient for brands, growth and scale probably had a closer tie together. But, so many brands are just propped up by, external financing, and it may not necessarily be the best thing to just be shooting for top line revenue all of the time. You could be much, much more profitable at a much smaller scale. But just getting that into people's heads is just so, so important.
Exactly. It also goes back to the importance of first purchase profitability because if you go back and look at that formula and you look at profit contribution dollars minus OPEX, first purchase profitability means that you actually generate total profit contribution dollars, right? It's a positive number that stacks up with volume and then has to outweigh the OPEX dollars. But when you're not first purchase profitable, right, with new customers, it means that there's a delayed effect before you generate that profit dollars to cover your OPEX. And if you don't have repeat customers coming back to compensate for the loss, you will ultimately generate negative net profit, which means that you can't scale, right? What that means is your net profit is shrinking, right? It's not shrinking, but the net profit that we generate goes into the working capital of the business, right? So it's that cash flow that gets injected into the business, and then we repeat the cycles over and over again. So when your net profit margin is negative, it means that there is actually cash bleeding out of the working capital. And you need working capital to scale because that's what the actual foundation of it is. What happens with a lot of brands is that the moment they run a series of unprofitable months, net profit is negative, right? Or very slim. They have to compensate for the shrinkage in their cash flow and the working capital with outside capital. So they have to borrow money. And that's what this, negative or this domino effect in the cycle. So to break out of that cycle, to stop refinancing and borrowing money from investors and creditors, or borrowing money from creditors and raising money from investors, you have to become net profitable, not just generate profit contribution.
100%. One consistent piece, and I suppose we'll probably touch on to this, but one interesting point you mentioned there is, I suppose, that need to be first order profitable, or if you're not. I think that actually leads nicely into the second point here, is managing cash to actually accelerate profitable scale, because, a lot of brands that we speak with, when we actually start getting down to it, we ask them, are you first order profitable? Is it taking 2, 3, 4 months, 4 orders, whatever it's going to take for that customer to become profitable? It's not always very clear immediately until we maybe get them plugged into StoreHero where they actually lie. And I think at the root cause of maybe the indecision or the confusion around when they're becoming profitable is a challenge with personally how I see most brands measure this term lifetime value. The value component of what lifetime value actually means is extremely variable depending on the organization and the individual within the organization. And it's, lifetime value can mean so many different things. If you're using Shopify's just revenue and you're based in Europe, you're also including all of your VAT, which is not any of your money. You haven't extracted out any of your costs. And just say, for instance, we have two brands over the course of 12 months that generate €1,000 in revenue. One of these brands has 70% gross margin, the other one has 30, but you've just told, your boss that we both have €1,000 lifetime value. And, how do we make customer acquisition costs, decisions around that data? But unless you're really looking at it on a true gross margin basis, you're going to end up in hot water faster than you know it.
Yeah, that's the kind of beef I have with LTV, because LTV is revenue based, right? You just look
Yeah,
at the revenue, and sometimes, again, like you said, the biggest problem is when they bundle it with taxes that are not really yours, right? That's why I always suggest to look at LTCM, which is a different version of LTV. It looks at the profit, right,
yeah,
generated. So it's lifetime contribution margin. What's the profit in dollar terms generated by the customer in their lifetime? And that adds the cost of goods sold, the cost of delivery and transaction fees into the mix so that you get a sense of what the actual profit contribution is. And then you compare that to the customer acquisition cost, again, blended or weighted customer acquisition cost based on all your channels. And then you figure out, okay, so we got this cohort of customers in January 2024, right? It's been 10 months now. Let's look at how their value compares to some other cohort in May, for instance, right? We see the trajectory, we see how that develops, whether they are profitable or not, what month they turn profitable, and then we can make decisions that way. Because again, if you're not profitable at the first purchase, okay, that's fine. You just gotta understand that you can make sacrifices if your LTV growth is strong over time. So you will compensate for the loss early on. But if you don't have strong LTV growth, let's say it doesn't grow beyond 20% within 180 days, right? You gotta minimize the losses early on so that you don't have to finance the loss with external capital, right? Which will cost you money as well. It's all about that decision making. It's not to say that, oh, well, you gotta be first purchase profitable. We're not being radical here, right? It's not about either or, it's about context and understanding what happens if we don't turn profit on the first order. Can we sustain our operations? Can we compensate for the loss with repeat customers and repeat profitability. Sorry.
So this is obviously the second pillar of your program right now, managing cash to accelerate profitable scale. Within that pillar, what are some of the biggest challenges that you see brands having? Is it around that misinterpretation of what LTV stands for? Is it, not clearing any stock quick enough? Or what are some of the challenges, and maybe what are some of the best recommendations or results that you've been able to implement with brands?
Yeah, I mean, that is part of that because if you look at LTV, it may appear great. It may seem that you're generating enough cash flow, but you got to pay all these people, right? You got to pay the carrier fees, you got to pay your suppliers, right? And given that you don't have 30 plus payment terms, that's going to come out faster than you receive cash. And especially considering your inventory days, you could have a very solid cash conversion cycle gap. And again, each day of the gap must be financed. And you either finance it with your internal capital, which means less cash in the bank, or you finance it with external capital, which means borrowing money and then incurring extra costs, right? So all of those things are part of the cash conversion cycle. And the faster we can, the faster we can turn inventory, so cut the number of inventory days, which means focusing on blowing out overstock as frequently as possible, right? Not letting it stack up and controlling what we purchase, what we sell with an offer, right? If necessary. Then looking at your payment terms with suppliers, making sure that you don't pay faster than you need to, because again, that will enable you a better cash conversion cycle. Looking at your marketing spend and making sure that you can, buy back some of that, some of those days. For instance, switching to a monthly payment rather than daily rolling payment for Facebook and Meta could be one of the better decisions. Then seeing if you can supplement your cash conversion with tools like Parker. I know Parker is getting a lot of traction in the space, right? They're buying you extra 60 days, potentially up to 60 days in payment terms.
Incredible.
Yeah, exactly. Supplier financing, all of those things. And then also looking at when your repeat customers come back, right? Because that's your internal source of financing. You either get capital from your customers or investors or creditors, right? That's it. So customers is the most preferred option of financing, right? It's the best option. So the faster they come back, the better your cash conversion cycle becomes, and the more you can reinvest back in the business. And again, if you're profitable with the first purchase, it means that you get that profit immediately and you reinvest it back in acquisition, right? So if you're not profitable at the first purchase, you don't acquire customers with first-time customers. You acquire customers with repeat customers if you have repeat customers. And if you don't, again, you gotta borrow money to grow.
Within those kind of three or four key pointers, which one of those issues is most prevalent in D2C brands?
Depends on the category and niche, but of course, for most businesses, it's if they have a wide variety of products in their portfolio, it would be inventory days, right? And
Mm,
I would say that this is the most important one to look at, mainly because inventory, you look at the data in Shopify, and most businesses don't have inventory management systems, so they don't
yeah.
actually have a grasp on what their inventory, real-time inventory data is. And hopefully they look at it on a monthly basis, but even then, most don't, right? And they continue ordering as if there is an even split of sales between products, right? They just look at it, okay, I have a gut feeling we should order this, we should order that, right? That's how most operators and business owners approach it. They just lick the finger, okay, probably somewhere in that range, right? But they don't take into account the trends, the seasonality, the movement in their inventory sell-through rates. So they end up overstocking on some items, and that costs you money because every dollar sitting on your balance sheet for a long time, again, has to be financed somehow. So you finance it with the cash that could have been put to use on the marketing side. You could have acquired more quality customers rather than keep it on your balance sheet. And then what ends up happening is they have to sell that stock anyways at a discount during Black Friday, Cyber Monday, or some other big promo push. So when you have access to real-time data, you know exactly how much overstock you're building up over a given time period. That will dictate the offer and dictate the supply controls on your end. And you can actually untie a lot of capital within a reasonable time frame to help boost your cash conversion cycle and get rid of the liabilities, not the assets on your balance sheet.
Yeah, this is kind of the boring side of e-commerce businesses, in
Mm,
my opinion, and it's the side that I think there's so much room for margin expansion within businesses, and it's just
no.
so it's overlooked way too much, in my opinion. Way too much focus is simply going to improve the meta account, optimize our conversion rates, our average order value, improve the bounce rates. When it's actually a lot of back office stuff, basic management principles that we can put in place that can really fundamentally change the trajectory of the business and just really make it into what the business owner had really hoped to be day one. But
Yep.
again, it's something I consistently see all of the time. This side of the business, inventory, cash flow management, understanding your finances, is often left on the back burner. And e-commerce, people are probably listening to this sick of me saying this, but I think it's really changed and evolved from simply a marketing exercise to starting with the fundamentals, starting with the numbers, and then making your marketing fit around those fundamentals and those numbers that you've already set. So that kind of brings us on to the next point. So we've kind of looked at the fundamentals of profitable scale. We've looked at managing cash to accelerate profitable scale. So the next thing we need to do is we have our P&L locked down. We understand our cash conversion cycles. We understand how our cash flow is coming into the business. How are we using that data to deliver and drive actionable insights?
Yeah, that's a good question. And again, I mentioned that already. I have a playbook of 5 or 15 key business questions that I typically ask. And of course, I'm not going to share the entire thing. That's the purpose of the cohort. But let's say we look at our P&L, right? And we know our average order value, right? The question is, what should our free shipping threshold be? That's one of the questions in the playbook, right? A lot of businesses approach free shipping threshold as a sort of, well, we gotta give shipping away for free, right? That's not the case, right? Free shipping threshold is a lever that you have to play with. You don't just give it away for free. You gotta make sure that your customers have to earn it, right? They have to work for it. And of course, in the sense that you gotta, it's kind of like this. I don't know if you've heard about it, but it's like a big mouse and small mouse experiment, right? A big mouse will let the small mouse win once in a while so that the small mouse doesn't lose the desire to continue playing, right? And it's the same thing here, right? You don't want to give your customers away everything, and at the same time, you want to give them something, right? So you got to figure out and analyze your average order value distribution as well as the average order value itself. For example, I know one brand that recently came to me and they said, look, we changed our free shipping threshold on the 24th of July. Did that carry any impact for us? And I said, well, what did you base that decision on? So they went from $125 down to $95 shipping threshold, right?
Yeah.
So why did you decide to make that? Well, we just felt like it would incentivize a lot more customers to spend more because it's much closer to the actual average order value. And again, their average order value was sitting about, $90.85. So it made reasonable sense for them to set it at 95 because it was just above the average order value. And that's what a lot of professionals say in the space. However, what happened was when we analyzed the distribution of orders, right, on the
Mm.
chart, we found out that there's actually a lot of customers lending in the range of $30 to $50 and a lot of customers lending, way above $95. So that change in shipping threshold did nothing for them. In fact, there was actually a lot more customers not buying more because there was no incentive for them to spend closer to $125 since they could have gotten their shipping threshold at $95, right? So that was an interesting discovery because again, there was no incentive for customers who were buying small or lower ticket item who would land in $30, $50 range for them to spend closer to $90 because again, it's still far away for them. You would either have to drop the free shipping threshold to $70, but then your unit economics doesn't make sense because you're giving away the shipping threshold or the shipping for free for too many customers. But then raising it back might not make a difference either way. So we would have to figure out a way to push people to spend more on the first purchase without using the shipping threshold. Type of kind of questions you ask yourself, because again, it's all about starting with the right business question before looking at the data and then actually building a strategy. When you look at the numbers without context and without asking the right business question, it's just data on paper that will not be meaningful for you in any shape or form. But when you ask the right business question, you will naturally gravitate towards the data that could potentially answer that question. And once you've answered that question with the right data, you can build strategy around it.
You do need a lot of underlying industry knowledge to ask the right question.
Mm. Totally.
Somebody who's not familiar with the industry, and we end up speaking to a lot of financial controllers, directors within e-commerce businesses, and they've been brought in from another business to run the finance of this business, but
Yeah.
their previous experience, they would have had plenty of experience, excellent at their job, without having the underlying context of e-commerce and how all those variable components you've just touched on interlink with each other. It's very, very difficult to ask the right questions. And I completely agree with you. You can only get the right answer if you know how to ask the right question. So I think it's just so, so important when you are, working with a finance professional to run your e-commerce business. Like, nobody thinks twice about outsourcing their marketing to marketing experts, but often we don't look at the caliber of the finance person who's actually going to take on the financial decisions of the business, and actually are they necessarily aligned with the industry that we're working in. And I think that is often a bigger problem than scaling meta ads, and a lot of e-commerce operators just unfortunately are not familiar with that, and it's just so, so crucial and so, so important.
Absolutely. And that's part of the reason why I don't necessarily position our firm as a fractional CFO firm, because we're slightly more than that, right? We go much deeper. We'll look at
Deeper,
the
yeah.
operator level of insights. What are those levers that each operator has? It's like shipping threshold, the allocation of budget across repeat customers and new customers, right? How do you allocate that properly? What kind of offer should you build? How would you segment your customers? How would you look at your product portfolio in a different way so that you can maximize the daily profit contribution dollars, right? So all those things are part of the offer that we've come up with as growth consultants.
Okay, and I suppose that leads us to the final pillar of the cohort, which is kind of converting insights into strategy. Talk to me about that. Obviously, we could dig into this one for days,
Yeah.
I'm sure, Val, but try and give us a high level overview and maybe some of the challenges and also the opportunities that you've been able to uncover for brands within that.
Yeah. I mean, the biggest one is, again, never take the current situation for a given forever, right? That's the biggest takeaway that I've got away from working with businesses for over 6 years. Every time I start, and early on, you always doubt your expertise and your experience, and you kind of like, okay, well, maybe they're right, right? Maybe there is nothing else to do. And it's like, well, look, we've done this for years. We haven't found, a way to grow past this point, or we haven't found a way to boost our margins, or we haven't found a way to extend our cash flow. We doubt you can do it, but let's work together, right? And then you come in, you kind of like approach it from a doubtful perspective. It's like, well, maybe I don't know enough to help them, right? Maybe they're right. Maybe there is nothing else to do. But then you start digging and you actually unravel so many different insights and kind of like the cause and effect. And you figure out, okay, well, there's actually a lot going on the wrong side. And there's actually a lot of overstock and there's actually a lot of mismanagement done on the back end. So the key takeaway is always have your ego put aside when it comes to business and making money, right? There's always someone who knows more, right? There's someone who knows more than me, 100%, and they will teach me how to do it better. And the same applies to you. If you think that you've got the right strategy that will generate money for you, why are you unprofitable now, right? Maybe you don't have all the answers, right? So that's step number one. Always accept that there is someone who knows more than you and they can help you. That's what they want to do, right? They want to help you. They want to help you find the right answer, the right priorities, the right bottlenecks to address first. And the second thing is, again, like on the strategy side, there's so many things that you could do, but you got to start with the right business question. I think the third and fourth pillars are kind of
Yeah.
intertwined. It's about, ask the right question, then get the right insights, and then make a change, right, in the company. The same applies with the shipping threshold. For example, the thing that we actually implemented for that business, who was not, there was no impact on the average order value. The average order value stayed the same. And again, because there were so many customers clustered way below that. So what we did, we actually implemented a gift card upsell. So basically, if you were $30 away from average or from the shipping threshold of $95, right? You could just get yourself the gift card for the next purchase, right? And again, they had decent repeat potential. They had a lot of customers coming back, which meant that there's actually a good product, right? People coming back, they're happy to shop again. But some customers would not repeat as often. So we thought, okay, let's implement this gift card upsell. They keep their money. It's just they deposit it with us for the next purchase. they get their free shipping threshold right away on the first purchase. The average order value goes up, right? And that way we get more money up front. They get to keep their money for the next purchase without having to purchase something that they don't need now, right? And it's a win-win for both sides. And we actually discovered that that resulted in a lot of positive outcomes.
Nice. It's one consistent challenge we see with a lot of brands, and we plug in
You
StoreHero as well, particularly around just discounting, over discounting, and I think to your point, just ill thought out discounting. A lot of brands, like one in particular stands out that they had a pretty hefty size product, so that therefore the shipping was quite substantial. Relative to the AOV, it was pretty substantial, but yet we were giving free shipping out below average order value, and there wasn't a massive distribution in the medium value of orders, so it didn't really make that much sense. And on top of that, I think it was a 15 to 20%, a discount that we were giving out in order to just sign up for the email program. So, those two things combined, on top of the fact that the business, was only baseline, like pre-discount, 50% gross margin. So, it was a tough business to scale. And, a lot of the focus in the business was simply just focused around trying to improve creatives, trying to improve conversion rates and the meta account, when there was some really basic fundamentals that just could be improved quite easily. And just one business in particular, we were able to improve gross margin by, I think, 13% year over year by putting some really basic things in place. And like the meta account stayed the exact same, and the business is just a completely different business now. There's loads of small basic things that just get overlooked. I think at the root of a lot of these challenges or problems is that often people who, I suppose a better way of putting this is, a lot of the times in the e-commerce businesses, somebody who has the power and authority to implement some sort of discount isn't necessarily the person who's in charge of the finances or making strategy decisions from a financial perspective. They're often KPI'd or targeted on simply generating revenue. And those two incentives are if you optimize somebody or KPI somebody simply to generate revenue, it can very much lead to misaligned expectations or incentives if that person has full autonomy over discounting and what kind of budget you're going to spend on meta. And that's just one consistent challenge I see over and over again, that unfortunately marketers are a lot of the time responsible for a lot of the finance decisions within a business without necessarily understanding how that knits back to the marketing of the business writ large.
Very well said. Very well said.
Val, any other bits of wisdom or any other kind of, I suppose, key challenges that you've seen with brands or anything in general, really? I know we've had a lot of back and forth over the years. I've learned so much from a lot of the content that you've put out as well. So eager just to get any kind of challenges, trends, anything you're seeing at the industry at the moment.
One of the things that I'm pushing really hard is the gross margin, and I'm getting a lot of backlash for it, but let's try to unpack that. So I say that a gross margin, so again, your profit after cost of goods sold or product landed costs, your cost of delivery or last mile delivery, your 3PL fees and transaction fees should be at least 60%. Okay, that's what I'm advocating. So what I'm saying is, if I were to start a business today in the D2C space, I would want a minimum of 60% and ideally closer to 70% gross margin. And by far, I found gross margin to be one of the top predictors of success in the business. And again, the reason for that is because you have way more room on the marketing side, which is extremely competitive now, to advertise, to build a brand around. And you also have the luxury of investing more in biz ops, right? When your gross margins are tight, let's say below 50%, you have to be extremely lean with OPEX, and you have to rely and hope that your marketing efficiency will be there. Otherwise, you're screwed, right? And that's what happens with a lot of CPG brands. At some point, because the margins are extremely tight in that space, and I understand that, right? They have to push for retail just because they need enough volume with profit contribution dollars to cover their OPEX and continue operations. Otherwise, they're basically run out of business, right? So gross margin requires a lot more attention and a lot more optimization than most founders think. And it all comes down to supply chain management. So if you think that there's nothing you can do, and again, if you're a reseller, that's a different conversation, right? I'm not talking about resellers because resellers have so much to do. But again, your average gross margin could be improved by launching branded products, right? So you start a reselling business, but then you continue to build up the portfolio and add more products that are higher margin, right? So it's a different conversation. But if you don't have the luxury of adding more products and there is so much you can do, you have to optimize the supply chain. And if you have control over manufacturing, or you have access to your manufacturers and you have access to your freight companies, you can see how many different partners are involved in the supply chain, right? It's manufacturers, packagers, it's last mile delivery, it's 3PL partners. So each of them has to make money. They have to mark up the cost somehow, right? Which means that every markup that happens, you have the ability to control it better and have negotiations or have conversations about how you could save. If you save some money at every stage, you could optimize your gross margin to be much higher, right? And that's kind of the starting point. So when I say that you want it to be above 60%, hopefully closer to 70%, it's a template for a business that I would want to start today. However, it doesn't mean that you have to to fixate on that target and work towards it. It's just a benchmark and just a kind of a metaphor for you to not forget about the supply chain and continuously optimize it, right? But yes, like I said, if you want to be a successful brand, you gotta be above 60%. But if it's not a given, then find ways to get as close as possible to 60%.
You mentioned you're getting a bit of flack for maybe having this train of thought. I posted a very similar video having the exact same train of thought literally during the week.
Yep.
That gross margin is more important than your meta account, really.
Yep.
If that isn't set up or set up fundamentally from the beginning, it's going to be impossible to make anything else in the business really work. So I'm in complete agreement with you. I definitely think you're 100% correct there. So, and again, I just think it's something that is overlooked quite a bit. Valentin, listen, really enjoyed having you on the show today. Tons and tons and tons of value within that. I'm going to drop a link to your LinkedIn, your website, and maybe just give a couple more links in the show notes below. But Val, I just want to say a massive thank you for coming on today. Really enjoyed that.
Thank you, Thomas. Always a pleasure chatting with you. And yeah, StoreHero is a great tool as well. So anyone, I've used it myself. If you want to get that level of insights to power action, I definitely stand by StoreHero and recommend to anyone.
Brilliant, Val. Listen, thank you very much, and we'll catch up again very soon. Thank you.
Thomas. All right. Cheers, guys.